Hi, everyone. This is John Pokeroba. It is December 26th, 2022. This is a special edition. This is my 2023 market outlook on the general market update and some very specific ideas for 2023. This is going to be a little longer than your normal video, but hopefully the content will be there and you appreciate the additional length. Okay, again, just to start, I'm an amateur investor and I'm not affiliated with IBD or MarketSmith, and this is a presentation by Rain King LLC. So our topic for tonight is we're going to talk quickly about the January effect. We're going to get into the current bear market update as we move into 2023, and we'll talk about how to find sector rotations in the first few weeks of the year. And we'll spend the bulk of our time, I'm going to share, I believe it's over 18 ideas for 2023, specific names. Okay, so let's talk about the January effect. It's actually kind of a trifecta. The January trifecta is the first part is called the Santa Claus Rally Indicator, and all of these come from the Stock Traders Almanac, which is the Santa Claus Rally is the last 5 days of December plus the first 2 days in January. And essentially that indicator has been produced positive gains of 1.3% since 1950. When that period of time is negative, it's usually preceded market corrections or bear markets. Then we have the January 1st 5-day indicator, and this is the first 5 full days of trading in January. When they are showing positive gains, it's usually an indication 86% of the time the year will be positive as well. And then the January barometer, and that's when the month of January is positive. It also correlates with the entire year being positive 73% of the time. But I would note that the January barometer has been wrong 4 of the last 7 years. So these are kind of factoids. Wouldn't put huge credence in them, but they are kind of fun to look at as the year starts. So the Santa Claus rally started on Friday. So we were up 0.59% on the S&P. So I'll track these, and in my next video, we'll see where we are in terms of the Santa Claus rally. First 5-day indicators I mentioned before, we'll track this. This is the first 5 days in January, and we'll get an update on that in the next video. So let's get into the bear market update. So again, starting with the long-term monthly chart, this is the NASDAQ. We're still down in this area of 10 to 11,000 that has been holding so far, but we're going to talk about where we are and what could be happening in the first quarter. So this bear market, and this is using S&P data going back to 1971. The current S&P low is 27.5% decline, and it's 282 calendar days to the current low, which was October. Now, major bear markets defined as at least a minimum 25% decline. There's been 6 of those since 1971. The average loss is 39.8%, and it's taken 546 days to hit the eventual low. So bear markets are months and years, not days. And there's also an average of 7 failed follow-through days. We had currently 6 failed follow-through days, but follow-through day number 7 is failing as well. And we'll talk about that in a little more detail in a bit. So it's probably no surprise the Fed hiking pace in this particular rate hike cycle is the steepest hiking we've seen in history. You can see it there on the chart. It's coming steadily, and albeit we're starting from a very low base. We basically started at 0. So it's a fast pace. Now, just wanted to look at the 2007, 2009, which was the last major bear market of serious duration, taking out the COVID year. And the way it played out was you had 1 leg down, you had a second leg down, and we had an undercut of a leg that recovered. And then we eventually had a third leg down, taking us to March of 2009. So the current bear market, we've had one leg down here, second leg down. We had an undercut of the second leg, which is the current low in October. We don't know if that low is going to hold or not. So it's really up in the air if we're going to have a third leg down or the October lows will hold. Just but though it's interesting to compare it to the last real major bear market of any time duration. Now, if we line up these major bear markets that I just referred to in the history books, 74, 82, 87, 2003, 2009, 2020, and 2022, here's what they look like in terms of the severity. 1974 was a 50% decline. You can see the other declines. I mentioned to you that the average bear market, which is represented by this blue dotted line, is 39.8% in 546 days. You'll notice how they all compare. We're off about 27% right now. So, if this is going to play out to the script, we might have another leg down. That's a possibility that we have another 10 to 15% to go in the S&P 500 to bring us down into this 39, 40% decline area. So it's just something to keep in our minds. That would bring the S&P somewhere down around the 2890 area. So it's an interesting reference point when you put this bear market in context with the other major bear markets that I've mentioned before. The market is all driven by psychology. I've used this chart a couple times over the last few years. And essentially, in a bull market, the emotion of greed builds slowly. Slowly as like a roller coaster goes up the incline. But when things finally, the bull market tops out, you get a very fast, fear-driven bear market. And the ride down is a lot faster because emotionally, the emotion of fear is much stronger than greed. Where are we on this chart? I propose that we're somewhere in here, between panic and capitulation. Some people might say, no, we're more at discouragement. That's fair enough to assess it that way. But it's interesting to see where we might be on the roller coaster. So the bottoming process, I wanted to show you, again, looking back at the 09 bottom. And what this chart represents in the blue line is the XLY, which is consumer discretionary, divided by XLP, which is consumer staples. And the orange line is the S&P as it was making its bottom in 2009. Now you'll notice that this low here in the S&P was a new low in this ratio, showing that XLY discretionaries were also hitting a new low. Then when the market hit bottom in March of 09, represented by A, you'll notice that the discretionary started to outperform. We got a divergence where the index made a new low, but the ratio was showing outperformance by consumer discretionary. So that was an important clue that maybe bottom was in this particular bear market. So what does this ratio look like today? Here we are, same ratio, 2022. You can see we had the lows back in June, and the XLY ratio made new lows. You'll notice that when the market made new lows in October, the XLY ratio has just continued to make new low after new low after new low. And it's making new lows as of Friday. So essentially, we're off script. The defensive staples, consumer discretionary, is actually outperforming. The staples are outperforming consumer discretionary. So if the October lows are the bottom, it's certainly not supported by what we're seeing here in the XLY ratio. So as some of you know, I'm an architect here in Boston. So I wanted to share a recent presentation that a firm made that I was attending, and it had a couple of interesting slides. As architects, we're always following some of the materials and commodities for understanding what are the cost of buildings going to be. Are they trending higher or lower? So this is actually commodities. They have oil, lumber, gold, and copper. You'll notice that since January of 2022, there was this spike occurring in materials that lasted until around March of this year. And you'll notice that many of the commodities have started to come down. Lumber and copper, but they've all come down, but some of them are more dramatic. So the commodities have been coming down in the construction market. Now, this was an interesting slide about Fed Reserve monetary policy. There's a number of lines stacked here. This dark, heavy line, this is the New York Stock Exchange. So this is the NYSE. You can see here's 2022, the declining bear market. This green line here is actually the Federal Reserve assets. Then we have a blue line, which is GDP growth. This purplish line is the personal consumption index, which I'm going to talk about in a bit. And then we have the Fed funds rate, which is spiking up. And unemployment rate which is also in the yellow line. So let's zoom in a little bit on this and look at what it's telling us. So here we are with a blow up. So we've got the NYSE in a bear market. We've got the Federal Reserve assets that were at 8.5 trillion or so. They were at 9. They've started to come down as the Fed is, quantitative tightening has begun. The Fed has said they want to be at 5.9 trillion down here in 2 years. So again, someone has to buy all these bonds that are coming to market from the Fed, part of quantitative tightening. Now, the personal consumption index, the PCE indicator, I think is very important at this time. It's a broader measure of inflation, and it's one of the tools that the Fed is looking at that is very, very important. You'll notice that throughout 2022, this index is not, coming down. It's really been straddling 5. And they really haven't been able to really bend it down, as opposed to the consumer price index, the CPI, which is in this purple line, which we know has, after its spike in June and July, this has started to come down. So that's coming down, but I would submit that the Fed is really looking at the personal consumption index to see if they can really bend this down. Their stated goal, was to get the PCE down to 2.5%, which is quite a bit to go. Historically, the PCE has been at 1.7 range. So keep this in mind, how this actually is going to happen. Now, the gold line, the unemployment rate, is also, is really, really low. There's very, very low unemployment. Now, job growth every month has started to come down from almost 500,000 jobs a month to about 300,000 jobs per month. And I put a big but. So I want to look at this a little closer. So this is a chart of US jobs growth from that presentation that I attended. So the black lines are showing every monthly report. We're going back all the way back to 1987. So I've put on the chart official recessions coming from the National Bureau of Economic Research. These gold bands are recessions that we've had. Now, we currently are averaging 500,000 a month for most of 2022. It's come down to about 300,000. Now, the interesting part to note is typically, job growth is around 100,000 jobs per month. Now, you'll notice that during these recessionary periods, right before the recession, typically job growth will slow to a less than 100,000 jobs per month, typically about 6 months before a recession officially starts. See these pockets? There, you're falling down below 100,000 jobs. This is almost 6 months before the 2000 top. And we also have it happening again, this phenomenon of the job growth really drying up. Now you can see we're not anywhere near that. We're way up, still trying to get the job growth from 300,000. The Fed's got to get this down much lower if they're going to drive the PCE, the personal consumption index, lower. So there's still a lot of work that the Fed wants to see to help not only the CPE come down, but the PCE, which is a job-related factor. So that's really, really important to keep in our minds. Now, let's go back now to retest the signpost that we had looked at last on December 15th. We talked about follow-through day number 7, and I had some The final successful follow-through days after a bear market is over had certain characteristics. And one of those characteristics was the max drawdown of really only 5.65% in the first 13 weeks. And as of December 13th, things were starting to come off hard, and we were already 4.8% correcting. So it was getting really critical to see if this premise would hold up. So let's look at this now. This is on December 23rd. This pullback now, and I tweeted this out, is definitely abnormal. We're almost 81.1% off the highs, way further than what we've seen historically at bear market bottoms. So that's really not a good sign. That premise that we were following does not look good. And then I would say below that we had in October is still the official breakdown. Below that low would mean the rally is officially dead, though, but we've broken multiple follow-through days. We've broken some other important markers along the way. So it doesn't look very good as things come back down, at least to test the October lows. NASDAQ is not doing much better. It's actually far worse. It never was able to rally up to the 200-day moving average, and its pullback is 11%. Don't you remember in bull markets when we had pullbacks of 10%? Those were pretty severe corrections. Well, this pullback in itself is 11%, which is not surprising when you're in a bear market. So the summary on this market right now is, the Fed does not want to see a strong market rally, and they'll probably talk it down even more when we get into January. A strong market would mean personal wealth, which means more spending. And if consumers have more to spend, they're going to pay high prices, and inflation will remain to be very, very sticky. So the Fed does not want to see a big rally in the market. We also know the market is looking 6 to 9 months ahead. And I mentioned this labor market, which is related to the PCE, the personal consumption expenditures, is a big headwind. The Fed is going to probably have to keep raising interest rates, albeit they may make those rate hikes smaller until they see that the labor market has really cooled off. And it's still pretty hot demand for jobs. Now, the other headwind is earning estimates are likely to come down dramatically in the next earning report cycle of Q1. That has the potential to ignite the third leg down. We talked about maybe this bear market had another 10 to 15% to go. So it's going to be interesting to see how the market reacts. I think you're going to see a lot of estimates that are anticipating a recession, and you're going to see these downgrades coming that really could spark some more selling. And it is possible maybe we get the low of this bear market sometime late in Q2. Fed lag. By the time the Fed actually sees evidence that the PCE is coming down, headed in the right direction, the hikes may have gone too far and the recession will be way underway. So we'll have to see how it plays out. Now, January is always a really important month. There's a lot of sector rotations from institutions as they prepare for 2023. The China reopening is also a risk because a reopening of China could fuel demand, and demand could possibly reignite higher inflation. So it's just a wild card in the mix. But what's most important is, even though 22 has been very ugly and depressing, and we've all taken our bruises along the way, it's really important to stay engaged with the markets day by day to see how it plays out, to build watch lists, and to watch the market day by day. So let's go into January. I want to talk a little bit about sector rotations and how can you spot them and why they're important in the first few weeks of January. So, we all get a fresh start in January. We're all starting at, $0 year-to-date gains. Now, mutual funds are also in this position. Everybody is starting the year. Mutual fund managers are highly competitive, and their performance gets benchmarked against the indices. So, they're all looking to reposition their portfolios to have a successful 2023 campaign. Now, this repositioning by the funds is really important because if we're looking for their footprints in the first 3 to 4 weeks of the year, we might be able to spot some very important clues using volume, using sectors and groups, and then eventually driving that down to individual names. So, well, let's talk a little bit about how we could go about this. So the analogy I use is to call, Russian dolls, where you have, these small dolls that open. There's a smaller doll inside. You open up that one, and there's another doll inside of that. If we look at that, there's kind of this process of peeling back the onion from sectors to groups to names to building a watch list. Now, IBD's data and research has shown that 37% of a stock's price movement is directly tied to the industry group, and another 12% is due to the strength of the overall sector. So when you put these together, you're talking about almost 50% of a stock's move is due to the strength of its group and sector. So a couple of screens that I use, and I'm sure some of you have good screens as well that I use usually in January, and they're good screens to use throughout the year. These are Market Smith screens that I'm using. Is one I call Daily Up on Volume screen. Here's the criteria if you want to use Market Smith. You should run this every single day, and we'll talk about what to look for. Same screen on a weekly basis. Up on volume is important. And then this screen called Trifecta. And it's really looking at relative strength, accumulation distribution, and industry group relative strength. So it's important to run these screens often at the beginning of the year as we try to look for where the leadership of this market might be. So I've just kind of expanded, when you run the screens, you can do this in a variety of ways. Market Smith, if you use Market Smith, the Growth 250 has a number of preset screens. And one of them that's really useful is the relative strength line at new highs. Use some of these lists and review the stocks. You want to know when you run your screen, well, how many names are in the list? What industry groups are showing up and dominating these screens? And you can change these columns. So I encourage you to run the screens, maybe on the previous slide, or create your own. But you're trying to find, some sector screens and some group screens. Now, this is a slide from January 16th of 2022, which if you run some screens from last year and did some sector analysis, this is what we saw in the first 2 to 3 weeks of 2022. We saw what was starting to outperform: oil and gas, energy, metals, and industrials. And predominantly the first half of the year in 2022 was dominated by these sectors. So this shows up. If you ran your screens, you start to see these, and you peel it back some more, you get into some of the groups in these sectors, and then eventually get yourself into the names, and you can find some real good leads on where institutions are positioning themselves. So now we're going to get into really probably the fun part of the presentation. As I call it, a baker's dozen's ideas for 2023. So I have 18 ideas to share with you. I'll try to move fairly quickly. Now, it's important with these ideas. I'm looking at these with a 1-year time frame. Some of these, I don't expect some of these names to be jumping out off the charts in the first quarter, but I'm looking at these and saying which one of these names could have a very successful year and be higher when we get 12 months out. So please keep that kind of lens. These are not buy recommendations by any means, but I am using a combination of fundamentals and technicals, and I'll take you through what I see and in terms of what I think are decent ideas for this year. Now, 6 of the names that I'm going to share with you are really, I'll call them recession plays, or they're plays that say maybe in the second half of 2023 we start to see the signs that rates are going to fall. The Fed has completed their rate hike cycle, and maybe we're going to see some falling rates later in 2023. So there's 6 names we'll go over there. Then I've got 10 growth names to keep your eye on as the year's progressing, and we'll have to see how growth plays out. Growth has been beat up quite a bit in 2022, so we'll have to see how they perform in the first half of the year. And then I've got 2 I'll call them mad money ideas, more speculative ideas. I'll put them out there and we'll take a look at two stocks to look at. So let's get into it. This should be fun. I'll try to move quickly. So the recession falling rates ideas. The first one I have is TJX. TJX is kind of an off-price goods producer. They have good quality goods at a good price. And I use this as a recession play. They're primarily a brick and mortar model. They have record earnings forecast for 2023. This is not a 14%. This is not going to be a rapid growth stock, but it's a steady, slower grower. The group is strong at number 11, and there's a large, big ROE at 58%. Now, what I like about the chart is this is about a 20-month base breakout that we just had here in December. And the other thing that's very attractive is as a slow grower, you can see a very steady relative strength line. And the RS line is at new highs. And there's no major kinks in this relative strength line. So this is a name that I think might have some potential, particularly in the first half of 2023. Next name, Caterpillar. Again, big, long base. You can see a long base and near all-time highs. We came up off the bottom off this deep base, and the stock has essentially formed a tight, flat base near all-time highs, only a 6% deep base. In the base, I had a big gap up on earnings, and again, the relative strength line is already at new highs. So I think this, if China reopens, this could be a way to see some demand. It's a good-looking chart at the moment. So Caterpillar's on my list. They also have some very strong forward annual earnings. You'll notice that these earnings for 2023 of $15.22 would be record earnings for Caterpillar. And the China reopening I've mentioned with this demand for industrials and energy names. And you can see that recently in the last quarter, we've seen some blue spikes, and it's a big liquid name. So the next idea is called Flex Limited. This is basically a Singapore-based electronic manufacturer of components and circuit boards. You're really the low-cost supplier in the space. The new part of the story is they have a solar sun tracker for solar arrays at utility scale solar installations. And that part of their business is growing at 40% last quarter. You'll also know that this would compete with Array Technologies, which also has a solar tracking technology. The company also has EV battery development and connectivity. Now, if you look at the chart, what's interesting again is a very long 2-year base and a really steady RS line for the entire second half of 2022. And these circles are representing where the relative strength line was at new highs before the stock was at a price high. You can see here, I've circled this box here. We have earnings per share that are starting to accelerate. We also have sales that are accelerating. So we have accelerating earnings and sales. We have funds that have been up for 3 quarters in a row, strong ROE at 25%. And I mentioned a cup with handle base, a long base. And you'll also notice that as it broke out, we have 5 weeks up in a row, blue weeks, which is a really positive sign of accumulation. The group is strong at number 6. So all of these reasons make this something I think is something to keep your eye on as we move into the new year. Next idea is D.R. Horton. This is a home builder, which you may be shaking your head saying, why would you put a home builder with interest rates, mortgage rates going up so high, so fast? Now, D.R.H. Horton is the largest U.S. home builder. They have a 12% share. Now, mortgage rates have gone up and spiked, and it has slowed the new orders, and their backlog is down 10 to 15% in the latest quarter, which could be expected. Now, the idea is the market is looking ahead 6 to 9 months. So it's a possibility of play where long-term rates might start falling after the Fed is tightened in the second half of 2023. And the next 2 quarters for D.R.H. Horton are already forecasted to be bad quarters. But the street has kind of already baked all that in when they push the price down. The PE is only 9. This is really kind of a turnaround play for the second half of 2023. And I've mentioned a few times under Twitter that the XHB, which is the home building index, has really been acting very, very strong. It's possible that that the index is really looking 6 to 9 months ahead, and some of the builders are starting to perk up a bit. This is a big long base, and it's forming just under 100, which has been resistance for a number of years. So we'll have to see how it plays out, but that's an idea that possibly might get some traction as we get deeper into 2023. This is the TLT, which is an ETF of treasury bonds, and it's essentially long bonds, 20-year plus bonds. And the strategy here was we have this rapid Fed tightening, which has killed bonds this year. It was one of the worst years on record. So this is a recession play. If we get the economic slowdown in a recession and inflation comes down, if that all plays out, yields on bonds will drop and actual bonds should rise. Now, the TLT is down 28% in 2022, which is one of the worst years on record. If inflation does not tamp down, and mentioned that PCE does not come down, this idea probably will not work well if inflation remains sticky. But if the Fed gets this under control by the first quarter of the year, things start to stabilize out, it's possible that bonds may have a good second half of the year. And the last idea, I think, in this section is GDX. This is a gold miner ETF. Again, this is a play on if inflation comes down, bond yields and the US dollar should also come down as well. And as I mentioned, that might make a strong situation for bonds. It also could boost the precious metals. And GDX, you could play this in a lot of different ways. You can do the GLD gold ETF. GDX has a little more beta than spot gold pricing. And I picked this particular ETF because its top 5 holdings would give you exposure to Newmont and Barrick and a number of other important large gold miners. So kind of an ugly chart, but you'll notice things that come up off the bottom. So again, things have to fall into place for this to be successful, but it's an idea. So now let's get to some growth names. Most of you are probably growth investors, so let's get into some fun with growth. Celsius Holdings is high on my list. And these are not in a particular order that I'm sharing these, but Celsius is a strong stock to watch. It's got something new. It's got new energy drink, unique formula that activates the body's metabolism. It just signed this year, about 6 months ago, a huge distribution deal with Pepsi. So it's rapidly expanding its distribution channels, which is over 173,000 channels. I've noticed that when I'm in a lot of different stores, I'm seeing Celsius product on the shelves very, very frequently now. Now, Celsius, in terms of a chart, it bottomed way back in May, and it's been fighting this and had a nice little uptrend from a deep, deep, deep base. This is a 206% uptrend, which is really, really strong during a terrible bear market. And now it's actually formed a stage 1 cup base, cup with handle forming, and it's only 34% deep, much more proper than this sloppy loose base. This is constructive. And you'll notice that there's 4 weeks in a row on the right side with blue spikes showing accumulation and some peak closes in there. So, given the context of a horrible bear market, this stock is really acting strong. So you're getting this big cup with handle, mini cup with handle over there. So these are positive things. Now, good earnings and sales should be coming with this distribution deal, and the number should get stronger. I know that people might want to point to the earnings looking horrible in September, but the short-term financials had to pay the cost of canceling all the distribution deals that Celsius had with other distributors. They had to cancel all those deals and pay penalty fees in order to get the sole source deal with Pepsi. So that should be behind them. and we could be unleashing a good year of earnings and sales. Next growth idea is Enphase. Probably not a new name to people, but the strength of the name during the bear market is really remarkable. Enphase makes solar microinverters that have had very, very strong demand. US sales in Q3 were up 69% for their particular inverters. Their inverters are more efficient, and they also can operate even if a panel is down in the array or it's covered. The other microinverters will allow all the systems to still produce um, the electricity from solar, even if a panel's down. Now, their new product is this IQ8 microinverter, and that's 47% of their shipments. They're also doing stuff in the battery business and EV chargers, and you got some very good numbers. You got 2 quarters of accelerating earnings and sales. We've got really strong annual earnings. Look at the forecast. It's been rising since 2020, 2021, and we're looking at record annual earnings for Enphase. Now, it's a very volatile stock. This stock easily can swing 10% in a day, 10, 20, 30 points. So you have to take that in consideration if you're going to enter this stock and keep your position size manageable with the risk. Now, the chart, we look at the chart. What's interesting is that multiple times in this bear market, the index made a new low, but Enphase refused to make a new low. It's made a series of higher lows from a very long, deep base, and now it's formed a cup base, which tried to break out, and it came back in with the weight of the bear market. It's been outperforming the S&P since February all year, so it's a great story. This seems to be like a coiled spring. When the bear market ends, this stock could run. So that's an idea. Next is Shockwave. I've talked about Shockwave before, but they have a proprietary ILV technology, which is intravascular lithotripsy technology. Essentially, they have a system that produces ultrasonic shock waves through the body tissue to break up plaque in arteries and cardiovascular elements. Now, this is a technology that's been very much proven on kidney stones over 30 years. Shockwave is really entering its growth phase. They have a direct sales team, the US, Germany, Austria, etc., and they have distributors in 50 other countries. It's a huge total addressable market of 8.5 billion. In 2021, they received Medicare approval for coronary applications, which was a major, major milestone. Their procedure has lower rates of complications. It outperforms stents and angioplasty balloons. The test results show that they get better results 30 days to 2 years. Now, the form factor of this technology is very similar for a surgeon to use angioplasty balloon catheters. So it's very easy for surgeons to move from using balloon catheters to easily use the Shockwave system, which is important in terms of converting doctors to this technology. Big gross margins. These are huge earnings and sales. With an aging population trend, this is probably going to become even in more demand. Now, they do have competition from Medtronic, Boston Scientific, and Philips, but I think they have really got the elements of a potential true market leader. Triple-digit earnings and sales. So this stock, again, tried to resist the bear market, started to break out, but then it's recently, in the last 2 months, it's really broken down. Now, on the positive side, it's come down to basically start to hopefully can build a base on top of this previous structure. So I've drawn this black line. Maybe this stock can build a base, build some accumulation. It's been weak of the last 2 months, but I do think it's an interesting idea that has characteristics of a big winner if the market cooperates. Our next name is Insulet Pod. Again, Pod is, again, something new is going on, which is so important. They have the Omnipod 5, which is a wearable tubeless insulin delivery system for type 1 and type 2 diabetes. It allows you to basically personalize the treatment and control dosage through your smartphone. And they target users that are needing multiple injections per day. This makes it much more convenient. They're in the process of expanding their sales force to the European Union. Their annual earnings are ramping up. You can see here where they're basically forecasting record annual earnings in 2023. So that's really important. But again, competitive market, Medtronic, Tandem. But right now, the signs are that Insulet is winning with their new device, the Omnipod 5. Chart went from being very loose and sloppy trade throughout 2022, really couldn't be um, handled very easily because of the volatility. But you'll notice it had a very strong earnings gap on huge volume a couple months ago. And since then, with the market having all these gyrations, it's formed a tight, flat base. That's important. It hasn't given up the gains of the huge earnings gap of any significance. So I think this is a stock to keep on your watch list and could be a potential leader. Next, this is Impinj. This is a semiconductor play. Impinj sells Internet of Things hardware to retailers and consumer goods. They're essentially RFID tags, which are very thin wafers that are very easy to attach to consumer products. They're easy to read. They don't have a battery. They allow retailers real-time inventory, theft protection, quicker product returns, automated checkout. They also have some other software they've developed for in-store visualization of inventory. And probably the big trend here is only 30% of products today are, are not network connected, or excuse me, are network connected. So therefore, 70% of the market still could be moving towards Internet of Things. Now, I will say that, strong resistance to the bear market. It's still very close to new highs. This is one of the few breakouts that has been holding up amidst all the volatility, which is really remarkable. It's one of the growth stocks that's been very strong relative strength wise. But I would caution you that this is a volatile stock. It's fairly thin, trading only 484,000 shares a day and a small float. So that's something to be aware of, that this stock can move around quite a bit if institutions accumulate it, but also it can move quite a bit if institutions were to start liquidating this name. So it has risks, but something for your watch list. Nutanix is the next name I've put on the list. The story here is cloud infrastructure for hyper-converged systems between servers and data storage. They have a way to bring those in together into one single platform, especially if a company has apps that are in different clouds. They have a way to bring together all the clouds in your apps in terms of converging those systems. Now, what's new for Nutanix is they've transitioned from just selling hardware. Now they've moved into a subscription software model. So that's in place, which is allowing them to get some good traction. They have a 34% increase in annual occurring revenue as a result of that. So that's really important. The funds are about 430, which is still institutional quality. The stock has been very strong in the fall. You notice, look, it had a series of, I believe this was like 8 to 10 weeks up of blue weeks. They have had a couple of gaps. It closed at the peak. They've had some very strong tightness in here. This speaks of accumulation. Now, recently, I'm not sure if there was news or not, it had a major hit on Friday, but I think the stock is something to watch carefully going forward. It could have potential. Next name is Super Microcomputer. This is a computer hardware maker. They essentially make some of the most energy efficient green servers for computing and data centers and edge computing. The thing that's new is they have now offered what they call the total IT solution versus just selling these pieces of hardware servers. They've made these components all together to a systematic approach that they're plug and play for easy upgrades. And they've had some real success in the marketplace. They crushed their earnings and sales for Q1, and they had record revenue, 79% year over year. You'll notice that powerful 3 quarters of accelerating earnings and sales. ROE has been rising, and the group is number 41. All positive characteristics. And you'll notice that the stock, a little more volatile and choppy, but you'll see again, this is a rare breakout in the fall that is still holding up. You'll notice that we had 6 weeks up in a row, blue weeks here, and the blue was on pretty good size volume. So those are all positive characteristics. There is something new going on here. So again, another name that might have potential if the growth names come back into favor. Shift 4 payments is the next idea. This is a payment processor, and what makes them pretty unique is they have this real robust suite of payment acceptance solutions. They have systems that work with credit and debit. They work on mobile. They work with Apple Pay, Google Pay, web commerce. Very, very integrated. Now, their specialty had been and is retail hospitality, particularly including restaurants. And but they've made several key acquisitions in the last year to 2 years, and they've broadened and integrated this well. Finaro is a global cross-border payment provider they've integrated. Venue Next is point of sale solutions for pro and college stadiums and casinos. And this seems to be getting a lot of traction if you read up on the company. And their differentiation is really end-to-end platforms for all of the different payment channels. So the stock has had a 75% uptrend off the lows, and it's formed a base, but it's been kind of sloppy. But if you look closely at the closes of these weekly closes, 11 of the weekly closes are almost at the same level. That usually is a sign there's institutions that are accumulating the stock at a certain level. The biggest risk to this stock, I think, is recession. If we get a recession and a slowdown and transaction volume really slows down, that could hurt this company. But depending on if there's a recession or not, this company seems to be one of the newer names out there that has a good solution for the marketplace as a payment processor, which, there's always seems to be a payment processor, PayPal and Square in previous years. So it's an idea with some potential. Next name is Shopify. This name probably is familiar to all of you. This was actually the #1 winner for my 55 greatest winners study. This stock from 2016 to 2021 was up 5,765%. Now, when a big leader tops, we know they come off a minimum of 72% per studies. So the play here is maybe Shopify could be one of the rare breeds to come back to lead again. Historically, only 1 in 7 big leaders comes back. Thing that is still strong and forms the potential for Shopify is sales. The sales have been rising back for 2 quarters, and the earnings are forecast to return in 2023. So the idea here is now there's caution. There's a huge amount of overhead resistance on the chart. But the play that I'm looking at is possible that Shopify, even working up the right-hand side of a very big base, could be a double. You could go from 35 to 70 and be a double before we ever run into this huge band of overhead resistance. So that's something to watch. It's speculative in the sense that, will Shopify come back to lead again? Maybe. This might be a rare breed, but it's an idea that I'm keeping an eye on. And I believe this is the last growth name, Okta. Okta is involved in software security and authentication of systems for companies. Important segment of security in today's internet and access to servers. Now, they made some recent acquisitions. They were very bumpy integrations, which did not help their story, but they do have strong sales. They continue to be strong. This is a real turnaround situation. Don't know if it'll play out, but I do think we're seeing some big blue volume spikes near the bottom, but there's a lot of resistance in the 100 range. So again, this is more of a loose idea that I would like to keep an eye on. Now, 2 speculative names. And I say speculative because these are 2 names that I'm giving you from the biomedical area. One is more speculative than the other. So here they are. The first one is not as speculative as the second one. BioMarin Pharmaceutical. This is a legitimate biomedical company. They actually have real earnings and real sales. You can see they have $500 million in sales on a quarterly basis, and they have real positive earnings. Now, they make treatments for rare disorders. Now, their latest product is Roctavian, is a gene therapy for hemophilia A, and it's getting very close to approval. If it gets approval, it's going to be a nice shot in the arm for this company. Their big product that they're selling in 2022 that they have is Voxzogo has been released, and the sales are really brisk and doing well. And they have 6 other major drugs, including their bestseller, Zimazin, which has 623 million in sales. So this is a legitimate company to watch, and it just broke out to new highs from a big long base. So this is a biomed that has potential, I think, in 2023. Look at the estimates. They're expecting 201% increase in annual earnings. That catches my eye. Now, the real speculative mad money idea is Vaxcyte, PCVX. This is a clinical stage company with treatments for various pneumococcal diseases. They make vaccines essentially for bacterial disease. Now, the big product that's out there for this company is something called VAX-24, which it's on fast track designation, and they're pursuing what they call breakthrough designation, say this changes the marketplace. Now, the current sector for these types of vaccines is dominated, it's a $7 billion sector dominated by Prevnar, by Merck. But this particular product by Merck is waning in usage due to some of its limitations in the marketplace. Now, Vaxcyte had an October offering. They now have $1 billion in cash to get through the approvals and get this product to market if it gets approval. Those are all big ifs and all conditional. Now, they had a huge news-related earning gaps on some of the trial information. And the positive thing is it's holding its gains and essentially going sideways as the relative strength is very strong. We do see some big blue spikes. So again, this is speculative name in the biotech sector that might have some potential, but I would be very careful about your position size and how you control your risk. But I put in there to add a little bit of spice to the list. So there you have it. Those are my 18 ideas. Thanks for sticking with me for the length of the video. But you notice that I was looking at fundamentals as well as technicals. So there they are. And I'm going to put down the prices for these particular lists. And I guess it'll be fun. I'll kind of track these and we'll see how they do for the year. Maybe I'll have some winners, but I might have egg on my face if many of these don't perform well at all. Who knows? They're ideas. There's things to put on your watch list. Do some more research yourself. But I wanted to get something that had some ideas for you to launch you into 2023. So there you have it. Hopefully you enjoyed this video on my outlook of the markets. I think the first quarter is going to be very challenging. Potential for new market lows, but the other side could be quite rewarding. So keep your watch lists going. If you want to follow me on YouTube, you have this channel. There I am on Twitter. And I encourage anybody who wants to make a comment, want to send me a note, what you thought of the video, rainkingbullbear@gmail.com is where you can reach me. Look forward to the next video we'll do in early January, and we'll come back to the January effect and look at some of those and see what they're telling us. Thanks, everyone. We'll see you at the next market video.